What's up, guys? Profit to Profit back with another banger incoming. Today we're back on Finviz looking at the screener and some filters that can help you with growth investing.
Yeah, very excited for today, guys. So, first of all, before we dive into this, we want to give you a little reminder of the philosophy behind growth investing. So, we are looking for smaller or less established companies that are in growing industries and are expected to grow at an above average rate compared to their industry or the general market. And we believe, as growth investors, that this rapid growth will result in capital appreciation, which is the stock price rising, and that's what we'll ultimately profit from.
Just a quick note before we start: you don't want to use all of these filters at once. You don't have to follow exactly what we say. You can kind of manipulate these a little bit in any way, shape, or form that fit your investing goals. So take all of these with a little bit of grain of salt.
So, first of all, which I have conveniently already put up there, we have market capitalization. And here we are looking for mid minus companies, which tell us that a company has a market capitalization of under $10 billion. And this shows us companies that aren't already too large, because companies that are already too large are not able to grow at a rapid rate just because of the sheer size of them already. So this gives us companies that aren't too large, but also are pretty well established so that they're likely to get through any economic downturns.
Next filter that we want to go over is the IPO date, and we want to set this to in the last 5 years. And this just kind of shows us companies that are newer and recently became tradable. And obviously, this is an important trait for growth investing, as you don't want to be choosing the largest companies out there like Apple or any of these other well-established companies. You're looking for younger, less established companies that have a lot of room to grow. So that's pretty important. And next is EPS growth in the next 5 years. And you want to set this to over 20%, which is right here. And this shows us companies that are expected to rapidly grow their net income in the near future and maintain it for a solid amount of time, which is obviously that's very important. And then EPS growth in the next year, you want that to be over 25%. And this just shows us that companies that will be rapidly growing in the next year.
Yeah, after that, we are looking for companies within growth sectors, as I said before, because these mean that these companies have high growth potential, and their growth potential is greater than the general market. So here we can choose multiple options. There's healthcare, which is a good one. Energy is a good one. Technology is also a good one. Let's just go with technology for now. And as I said, these are just known to be high growing and innovative industries. And just so you know, this filter is not really as important as the others, just because growth companies can be in any sector. They don't have to be in these few sectors. And actually, it's better to not choose them just from these sectors, just for the purpose of diversification. So yeah, that's another filter that we have there. And then after that, we have beta, which is right here. And there's two big options for this one. You can do either over 1.5 or under negative 1.5. And for a little bit of context, beta is a measure of volatility, and it tells us how much a stock moves in comparison to the general market, generally a index of sorts like the S&P 500. So just to explain beta, stocks with a beta of 1 will move very similar to the market, going up when it goes up and going down when it goes down. Stocks with a beta of negative 1 will move pretty much opposite to the market. And a beta over 1 means a company moves in the same direction, but with more magnitude, going up more than the normal market does and going down more than the market does. And the same applies to betas that are less than negative 1. And I'd say that usually you want to look for betas that are over 1.5, because a positive beta simply means that the stock follows the market, but with a greater magnitude. And that's a good thing because the market mostly profits. Out of the last 50 years, the S&P 500 has went up 40 of them. And yeah, that's it.
So next thing we're going to do is we're going to move off of Finviz, and we're going to look up something like mid-cap companies with a high free cash flow yield, which we have conveniently already pulled up right here. And this will bring up a site called financecharts.com, and it'll bring up a huge list of possible growth stocks that you might want to invest into.
Yeah, so the reason free cash flow yield is very important is because, just so you know, free cash flow yield is free cash flow divided by market capitalization. And it tells us how much cash a company produces relative to its total valuation. And this is especially useful for growth investors because growth investors are looking for companies that are generally smaller or medium sized with a medium or low market capitalization, while also producing a lot of cash, meaning a high free cash flow.
So on this website, you're going to want to look for companies with a free cash flow yield ranging from 5 to 20%. And we have said this in our previous videos that this is the best range for a potential growth stock. And once you've found these, you want to calculate important ratios and growth rates, look at their financial statements, and just learn more about what the company does. And this will ultimately help you be able to pick a growth stock to invest into.
Yeah. Thank you, guys.
I love you guys.
Love you too, guys.